Wall Street's main indexes closed lower on Friday after disappointing earnings from Apple had investors bracing for more downside surprises. The Dow shed over 0.4%, the S&P 500 lost about 0.5%, and the Nasdaq dipped more than 0.3%. Apple's stock fell 4.8%, its biggest daily percentage decline since September of last year. That helped put a dent in the S&P 500 a day after the iPhone maker forecast a continued slide in sales. A partial counterweight to the blow Apple inflicted on the S&P and Nasdaq was Amazon. Its shares rose 8.3% the day after the online retailer issued an upbeat third-quarter outlook. All three major indexes posted weekly losses, with some investors taking profits after 5 months of gains. Meanwhile, data from the Labor Department Friday showed that U.S. employers added 187,000 jobs in July, fewer than what many economists had expected. Data for May and June was also revised lower. Despite the slowdown in job growth, Kevin Nicholson, Global Fixed Income Chief Investment Officer at Riverfront Investment Group, says the numbers reflect a still tight labor market, which will force the Federal Reserve to hike interest rates at least once more this year.
I think that as long as we continue to have a solid labor market, the Fed is going to have to continue to hike, because the bottom line is if consumers are employed, they're going to continue to spend. And when you continue to spend, that drives up inflation.
In other company news, Icahn Enterprises, owned by billionaire investor Carl Icahn, shed more than 23%. The company halved its quarterly dividend months after short seller Hindenburg Research accused it of operating a Ponzi-like structure for its dividend payouts. Shares of Tupperware rallied 35.5% after the company finalized an agreement with its lenders to restructure its debt obligations in an effort to turn around the business. And DraftKings shares rose 5.8% after the sports betting firm raised its fiscal year 2023 revenue outlook.